If you're running a business in India, you'd probably assume there's just one set of financial rules for everyone. You know, a single rule book. But, well, it's actually not that simple at all. The rules you have to follow, it completely depends on how big your company is. So let's break down this surprisingly tiered system.
So, right off the bat, here's the big question. Does it really make sense for a global giant and a local family-run shop to follow the exact same super complex accounting rules? India's answer to that is a pretty clear no. And their solution is this really clever classification system that we're about to dive into.
All right, so here's what we're going to cover. First, we'll look at the one fundamental split that divides the entire corporate world in India. Then we'll get into the nitty-gritty of what actually makes a big player. After that, we'll explore the perks, and there are some good ones, of being a smaller company. And finally, we'll touch on the new modern rulebook that's changing the game for the biggest companies before we wrap it all up.
Okay, let's jump into that first big idea. The entire universe of Indian companies is basically split right down the middle. You can think of it like a sorting hat for businesses, dividing them into two very distinct tribes right from the start. So on one side, you've got the SMCs. That's the small and medium-sized companies. And on the other side, you've got the non-SMCs, basically everyone else, the big players. And this single distinction, it's the foundation for everything that comes next. It dictates the rules, the responsibilities, the whole shebang. So why does this split matter so much? Well, it all comes down to what's expected of you. If you're a non-SMC, a big player, you have to follow every single rule in the book. No breaks, no exceptions. But if you're an SMC, you get some relaxations, a few exemptions. And honestly, that can be a total game changer for a growing business, letting you focus on growth instead of just complex compliance. So the big question is, how does a company actually get sorted into one of these two buckets? It's not just a feeling, right? It all comes down to a very straightforward 5-point checklist. It's designed to figure out who really qualifies as a big player.
Now, here's the most important part of this whole process. To be classified as a non-SMC, you don't need to check all the boxes. Not at all. Just one single yes on the checklist we're about to see is enough to land you in the big leagues, along with all the regulatory duties that come with it.
And here it is, the 5-point checklist. First up, are you publicly listed on a stock exchange? Number 2, are you in the financial sector? You know, like a bank or an insurance company? The next two are all about scale. Did your sales go past 250 crores, that's roughly 30 million US dollars, or did you borrow more than 50 crores, which is about 6 million US dollars? And finally, are you connected to a bigger corporate family that's already a non-SMC? Remember, just one yes to any of these questions and your world changes.
So you're probably asking, okay, so how do you become an SMC? It's actually really simple. It's a process of elimination. If you go through that entire 5-point checklist and you can honestly say no to every single one of those questions, then congratulations. By default, you're an SMC. It's as simple as that.
Okay, so you're an SMC. What does that actually get you? What does it mean day to day? This is where it gets really good. Let's look at the actual tangible benefits, the perks that come with being in that smaller category.
And here they are. This is a big deal. SMCs get full exemptions from some of the most complex and time-consuming standards. For instance, they don't have to prepare a detailed cash flow statement, which is a massive job under a rule called AS3. They also don't have to report on different business segments under AS17. These aren't just minor little tweaks. We're talking about a huge reduction in complexity, cost, and time. Now, just when you think you've got it all figured out, SMC versus non-SMC, the story adds another layer. Because over the last few years, India has started rolling out an even more modern, globally recognized set of rules. But, and this is key, only for the very largest companies.
This new rulebook is called Ind AS. You can think of it as the Premier League of accounting. It's designed to bring Indian financial reporting up to speed with International Financial Reporting Standards, or IFRS. And that's a huge deal. Why? Because it makes it way easier for global investors to understand, trust, and compare Indian companies on a truly level playing field.
Now, this didn't happen overnight. The rollout was really smart and done in phases. It all started back in 2015, when any company could choose to adopt it. Then in 2016, it became mandatory for the absolute titans of Indian industry. We're talking companies with a net worth over 500 crores, which is about 60 million US dollars. A year later, the net was cast a bit wider to pull in other large and listed companies too.
So here's a really crucial point to remember.
That original system we just talked about, the whole SMC and non-SMC split, it didn't disappear. Not at all. It's still the main rulebook for a huge number of unlisted companies in India that fall below those really high net worth thresholds.
All right, let's wrap this up with the key takeaways. First, financial rules in India are definitely not one size fits all. The system is tiered. The first big split is between the small guys, the SMCs, and the big guys, the non-SMCs, and that's decided by that simple 5-point checklist. Being an SMC comes with some serious perks, like getting to skip complex reports. And finally, for the absolute biggest players, there's now a new, modern, globally minded rulebook called IND-AS.
So we'll leave you with this final thought. These aren't just boring accounting rules. They're really milestones in a company's life. As a business grows and eventually crosses these financial lines, its entire rulebook for transparency gets rewritten overnight. So the question is, how does a smart leadership team prepare for that moment when the game suddenly gets a whole lot harder?